Hello, ladies and gentlemen, and welcome back. Well, we've just seen the inflation numbers and they're down, or at least on the surface, it seems to be that way. We've got a deep dive today into those, but also we need to talk about the FOMO. The FOMO is everywhere in the markets. Everybody's turned into a bull, the bottom's in, and of course, everyone is freaking out that hasn't been picking up the dip. Now, if you've been watching the channel for a little while, you know that we are very cautious here into August, September, and October for good reason. But at the same time, the market has still not shown us the bearish side. We'll show you guys in today's video where those key points are. We've got gaps galore, and I mean gaps galore that haven't been filled, left behind by this market. It's rallying at a pace that seems like it's going to go out of control, and we're about to achieve the 50% Fibonacci as well, which historically for the last 70 years has meant that the bottom point has been in. It doesn't mean there can't be a turn though. So stay tuned as we unpack this entire market right now. See you soon, guys. This is going to be a big video. Well, welcome back everybody to the daily show where we talk about stocks, commodities, and cryptos. Let's begin by talking about inflation data. It was led down by energy. That's probably no surprise to anyone that's been following this channel or really just following the news or even just filling up their cars. We saw energy drop across the board. Oil has been getting really shellacked and being sold off pretty heavily in the last couple of months, but it remains a geopolitical situation. So this can spike up at any time. We also saw some worrying numbers coming out from shelter. People are looking and diving into these numbers now, and you'll see that the bonds market and yields later on today's video represents this pretty heavily. Shelter is going up very heavily. That is rents. Will the government come in and control this? We don't know. But that and food in general are the two worrying points. If we take a look at this chart, you can see where things are dropping and where things are increasing. Inflation isn't over yet. We need to remember that. Has it peaked? Potentially. Is the Fed data driven? Absolutely. So it means every data point, including the PPI coming out in less than 24 hours, is going to be important for a trader and investor mindset. And remember, they are different. We will be talking about that later on today's video. Let's discuss dumb money versus smart money. What's going on here? Well, dumb money continues to pile in at an incredible pace. In fact, dumb money has been purchasing very, very quickly here. We've got some updated stats at this point. What I'm interested in, and we'll be sharing it later on this week, is to see how many retail traders have been opening up call options. We'll have those numbers later on, and I'm super interested because I have a suspicion it's going to be similar to March and April's number before the market fell off. What's happening though in terms of the big guys? What are the smart money players doing? Well, we saw a few days ago, BlackRock's CEO dumped 20 million in shares. Last time he did this was before the 2022 crash. Will that be a precursor? Who knows? It certainly could be. Before anyone feels FOMO though, just remember this. When we have certain reads, such as our previous read in the video, we've got to remain cautious and of course, look at the stats and understand where the markets are going next. If we had a move between 0 and 1% and small traders were purchasing incredibly fast in terms of call options, we tended to see a few months of relative weakness, that is sideways down and up around. That means it's probably going to be a trader's market here. And investors that miss the bottom, could the bottom be in? It's potential. We'll look at it later and talk about the stats with that. But realistically, it doesn't mean there won't be a pullback. And that's very important to think about here. There's a lot of Wall Street with shorts open. They might want to recoup some of that money, even if they were wrong. And this will then lead to markets really trapping, setting lower positions, and of course, potentially, we still may even go lower. We don't know that yet. SPY volume contracting. So what's going on here in terms of percentages? Well, we're still looking at some heavily percentage of contracts expiring in less than 5 days. So we need to look at that maximum pain statistic, which we will be in today's video, leading into next week. We'll check that out soon. What else is going on here with premium? We ran about this concept a little while ago. Basically, small traders obviously increasing their positions in the call side. We saw that happen back in 2020. We saw that, and that one led on to sideways for a little while and then up. In this case, in 2002 into 2003, we saw it have a secondary dip, something we are potentially expecting now. And in, of course, 2008, 2009, we saw this particular signal lead into a second dip later on. Remember, it didn't happen straight away. after this signal, it took a little while to play out, weeks into potentially a few months. Midterms are just around the corner. No one discusses it. Still, I'm going to bring it up every day. Why not? It does tend to lead into, of course, incredibly high VIX and spikes in volatility. Guess where the VIX is right now? Just turned underneath 20. If you're looking at average recessions, should we actually go into whatever they now call a recession, we usually see a 30% plus dump off on the SPY. That's just a statistic. Are we potentially moving away from that? We'll look at that later on. Where are we right now? We're at a very important point. If the market continues to ride too much higher, we have to kind of consider one of the cases here where the bottom is fully in and the market's going bullish. At the other case, there could still be a secondary dip, which most data points are pointing towards, especially that dumb money indicator where people like us, retail traders, are flowing into this market out of control. They don't necessarily know exactly what Wall Street's doing. And of course, that can lead into big problems. The dollar index is weakening. This is expected in some ways based on the stats. Look at yesterday's video if you're interested in finding out more about that. And as we know, in terms of mid-cycle kind of midterm presidential cycles, we usually expect September to be the worst month with a very strong October, November, December, at least historically. Does this mean that whatever dip we get in September and August, if we do get it, is bought up pretty heavily? Well, that's certainly an argument that you could be making in these markets. Let's move over to breadth. This is probably the biggest bull case right now. If we look at through all of the years of breadth and we consider breadth indicators where things start to improve, outside of 2008, most of the time when we saw big increases like this, pullbacks were met by buy demand and we continued to see them go through. So this is the SP 500 breadth above the 200, percentage above the 200-day average. And you can see that's doing a nice uptick at this point and has often precursored the bottoms in markets. It's certainly a bullish case scenario. We said we'd talk about it. It doesn't mean, again, that there can't be a pullback. That's very important to note here in these markets. Should we see the bearish signs, which we'll talk about soon. Q2 earnings, still 63% beat rate, getting worse by the day. Beats 1,832, misses 1,076. Frankly, this earnings season has been lackluster, even with the lowered expectations. It doesn't really fill us with confidence that much moving forward. Disney came out. I think it was okay. So Disney's done all right so far. And we can see here, most of the other earnings for the later part of this week aren't really that important. But if you are interested in any of those, you can see what's coming out. In terms of what markets did after the CPI number, they all jumped heavily. In fact, everything opened up huge gaps, 2% gaps, 1.5% gaps. They rode a little bit higher by the end of the day. But in general, most of the markets kind of didn't do much past that open. They just went a little bit higher. Certain rotations occurred, and it was all about risk on for the session. We saw clean energy PBW do really well. We saw solar doing really well. Semiconductors, which were beaten down the day before by about 4%, recover that. And we also saw metals, and everything that was risk basically was bought on. So before we jump into the charts any further and go into our detailed analysis of the markets, I'd like to thank the sponsor of today's video, which is Tiger Brokers. As many of you be aware, Tiger Brokers offers members of this community special offers in the description down below. And one of those offers is stock vouchers and coupons. So if you're using the desktop or app version when you open the account, you should be able to go down to a button such as down here where you've got the little package, and then you'll be able to actually claim your stock voucher. So you can press the open now and accept all the stock vouchers. Once you've done that, you'll be able to then check your rewards and activate them should you choose so. So what we'll do here is we'll activate one of our stock vouchers. We'll activate the Australian ASX ETFs voucher and stocks for $25. We can go about that by pressing activation, and you'll notice here that it comes up with, would you like to activate this? And you've got 30 days from the time of activation to use the coupon. We'll say yes in this case. So once it's activated, we can then go about placing a trade should we choose to do so. Here we have a stock called FMG, and we'll go to market, buy 30 of them, press market, and then of course proceed with the purchase. We'll do that right now together. And you'll notice that we now have 30 units of FMG in our account, and we're ready to rock. Now, what's going to happen is past this point, since we've placed the transaction, basically Tiger Brokers will rebate us that $25. So that $25 will be rebated to your account and usually take around 1 to 2 minutes to do so. So we'll just wait around together until we see that rebate process. So that certainly didn't take very long. The $25 has already been applied to my account after processing that transaction. And you can see here that we've got odd $25 stock voucher, and we can click on the more details should we want to find out more about the rebate, what's happened, the timing, etc. So one of my favorite features, as I've mentioned many times here in the videos, is being able to customize your own windows to your needs and set up the trading platform the way you would like it. Tiger Broker's desktop application allows this, and of course there's tons of flexibility in their mobile applications as well. So if you're interested in any of the special offers that we've been talking about today, plus some extra little bonus offers that they do have, you can look at the description down below. So let's now get into the charts. This is where things get really interesting. The VIX has hit the level we've been discussing, literally 20. So 21 was certainly one of the key points. That was something we were looking for, and we've just reached 20 on the VIX. This is where you see bulls and bears truly fight it out. This is the key point. So basically we saw this in February, we saw this in March before the drop, and now we're here in August before some seasonally weak periods in the markets, looking at a VIX underneath 20 with everyone FOMOing out of control. Is this the point to actually start to turn bearish? Well, the charts haven't shown us it yet, but certainly there are some key zones and areas that we'll be looking for on the SPY, and we'll come back to that in a second. What about the bond market? What did yields tell us about this? Well, initially yields dropped, and then all of a sudden they went up quite a lot. We've got here the February number. So this is where the yield is expected to be come February, 3.6%. So remember, the bonds market is still telling us some interesting things here. It's basically saying, hey, one data point is there. You're buying out of control in the market, but at the same time, we don't think that rates are coming down that much. In fact, we still think the Fed is going to have to raise rates to maybe deal with some of the other problems, the demand side. Even used cars didn't drop that much in that CPI report. Demand's still fairly strong here in this market. US 2-year, 3.2%. You'll see it actually spiked almost to a new high after that. Check out this 15-minute chart here. Look at this random spike that happened. Not sure what that was all about, but it basically is put back on what it lost. Again, if this continues to rise over the next couple of days and you're seeing the stock market rise, it is a huge warning sign given by the bonds market and yields in general, just saying, you know what, be careful. Put call ratio stays about 1. We're really interested in the small cap traders here at this point. So that's the retail traders. What are they doing? I'll give you the numbers later on this week. And if we look here at S&P 500 stocks above the 200 moving average, this is really a very good indicator that we've discussed before, that when you see this kind of go down into these levels, you could potentially be getting a bit more bullish on your investments. And look, we were bullish on the investment side and everything like that down below. It's something where traders and investors, you've got to have different scenarios. Mostly with investment, it's all about applying some form of dollar cost averaging strategy, understanding that there are key levels. You won't be able to pick the bottom perfectly, but these are the keys levels you look for. Traders don't care. Traders are just saying, where's the price action going to be in the next week, 2 weeks, couple of days, couple of minutes, couple of hours? That's what they care about. So at the moment, if you're a trader, you really don't need to feel any emotions, just looking for the next opportunity. If you're an investor, potentially you could be feeling FOMO. Harness the FOMO, come from the abundance mindset, and you'll find that whenever you feel really pained about something, often what will happen is a few days later, it will go in the opposite direction, allowing you to do whatever you wanted to do anyway. Remember, the market's job is to make you feel as bad as possible about your decisions that you're making. Whether you're buying at the lows and it feels bad and it goes down the next day and you think, oh my God, I've got to get out of this trade, or whether you're, of course, buying at the highs and you think, I've got to get back in, this market's getting away from me. Generally, you'll get an opportunity, especially when you harness those feelings. Dollar index over here, what's going on? Well, it dropped massively. I mean, dollar index went straight through our trend line here, and this is showing, at least initially, that the market was kind of saying, okay, well, maybe we can cut rates a little bit more and the rates won't have to go as high, and therefore that will weaken the US dollar. I'm not really feeling too much strength or weakness here on this one. It's recovering a little bit. At this stage, I'm probably looking for more information on the DXY, so we'll come back to that in the next session. What was really interesting though was gold. Gold came straight into this area we discussed in the previous session. That was amazing. In fact, gold actually looks quite weak now. I would expect rallies to be met by sell demand. This is the level, so that 1808 zone, certainly a key zone. If you put a volume profile on this chart, you go back through history, you're going to notice this is a super key level, and it smashed straight into that as we kind of expected, and now it's weakening. So we've got a peak, a trough, a higher peak, and we've broken underneath. If we get underneath this level here of 1782, we would expect gold to be retesting 1771 or 1755. Both of these levels here would be very, very key zones, especially the 1755. That's more of a defended zone. And I would expect probably the market to do something like this at this stage. It looks more likely that gold technically is short from this area than long. But of course, you always need to become flexible with your concepts. At this point though, even though I'm bullish gold over the next coming months, it does look a little bit short on the charts. Move over to oil, geopolitical issue. Oil actually spiked after that inflation number. So that's interesting again. If oil continues to drive up, what's that going to mean? Well, it's going to mean more expensive gas, therefore inflation back into this number. Watch the chart. At this stage, I'm still bearish on oil over a multi-month concept. But for now, anything can happen. And I don't really like what you're looking at in the charts here. If I was guessing, and that'd be more of a guess than anything else, you would say here that support has been met quite a few times and that there was a fairly aggressive buy off this. So maybe it's trying to get back up to test that 95, 96 zone at this stage. Don't really like oil just at the moment. I think the risks are there. What about the FOMO stocks, AMC, GME, obviously where we're seeing squeezes similar to March of last time. AMC really recovered pretty nicely through the session. Of course, the higher these go, the more likely we are in a bit of a bull bust where the market will go up and then it will have a drastic short off that could allow opportunity for people to get in if they missed out or whatever else they wanted to do. So watch these two charts. They will be on our watch list every single day. Tesla came off the support zone. Obviously, Elon sold huge portions of his own stock. What is it, 6.9 billion or something like that. Look, he's claimed, I believe, in some discussion that he would buy back in if the Twitter thing didn't go ahead. I'm not too sure about that, but what I will say is Tesla remains trapped between this point and this point, which is the highs of 940. A break past that should get us to the trend line. And if we get underneath this 840 kind of zone, then we look out down below 760 and possibly even back to 650. Anything's possible. Keep watching the stocks. And realistically, Elon selling these positions, in my opinion, is weakness over the medium term. I don't really like the fact he keeps selling the position, but you can let me know what you think in the comments down below on that. Apple just cannot be stopped. Warning signs though. Gaps everywhere on stocks at the moment. So many gaps. I don't know. It's kind of like, reminds me of this one over here. We saw Apple just out of control running. It ran, 11 days straight or something up, some ridiculous amount. And that was the warning sign. Over here, it's a Gapapalooza. That's what we've got going on, guys. Gapapalooza on Apple. It just keeps going up. It's now put in, let's just think about this, from the July low. So the July 1st, we've now put in 23% on Apple. That's an incredible gain and pretty unusual to not have decent pullbacks from that kind of point. Now, you can see over here, when you put in these huge percentages, even in 21, this is a big percentage, 25%, it still ended up retracing about 50% of that. So feeling FOMO at these points is not good. Of course, gaps are everywhere. You've just got to remember, be in it for the long game. Understand that when you feel bad about something, look, has the trend changed? We've been saying this. The trend has remained up. There's been no bearish signals yet. Absolutely no bearish signals. There still is no bearish signals. You're just trying to guess the high. At this point, 172 may be the high, and you'll see why when we look at the SPY in just a few moments. IWM versus the SPY. This is another chart a lot of people are looking at to show us that where the recovery is fully in. Often smaller cap companies, once they start out ticking the SPY, it shows a broad-based recovery. At this point, look at this chart. We've got a base formation that happened back in January and February of 2022. And at the moment, we're getting close to that resistance. Previously, we hit it in June. We all know what happened there. That's when we got that sell-off in 2020. We also hit it in August. Well, we all know what happened there. We got that sell-off, of course, in August. So we're coming up to this resistance between this ratio, and of course, everyone's feeling that FOMO at this stage. So very important, we're getting near that level. The DAX, here's the trend line on the way down that we haven't mentioned recently because we didn't get quite close to that. Obviously filled the gap over here. Do we have a little bit of a blow off, get close to 14,000, and that's it for the DAX? Watch the trend lines, guys. There's a lot of them going on right now. IWM itself broke past our little resistance kind of zone that we were looking and suspecting, leaving more gaps across everywhere. Yeah, that's just a sign of things. Of course, IWM having a good session. Do remember it broke out previously back over here in March, and then that left a gap behind, and that was the beginning of the end. So don't feel too much FOMO here, guys. It's still just a trade. Find your statistical edge. Once you get that, of course, trade it accordingly. Nasdaq didn't quite make a new high. At the time of recording, we did end up getting a new high in the futures market, but we didn't get above this. So this will be an interesting one coming into the PPI. Basically, we're still seeing a little bit of weakness on the Nasdaq overall. Big gaps left. Obviously, we can see here all the gaps that have been left behind in previous market low. We've got one down here from July, only a little while ago, back at 12,100. And will these get filled? It's kind of like our discussion point about these ones. We thought these would get filled for many reasons, mostly because everyone was so bearish. Here, everyone's starting to turn a little bit more bullish. So the more it goes up, the more likely, and the faster it does so, the more likely we actually do turn around. Again, it's important to just focus on the price action. Have we seen turnarounds? Remember, use the S&P 500 to make those judgments. S&P 500 is probably the best indicator in these markets for that. So we brought a stat up the other day, which basically said that if we get past 42.30, which we're getting damn close to doing, then the bottom historically over 70 years had been placed. That didn't mean that the market didn't come back and allow entrance into it. Remember, we've got gap here, we've got a gap here, we've got a gap left here, we've got a gap left here now, and we have a little one in here and down the bottom. So there is 1, 2, 3, 4, 5, 6 gaps left behind. That is semi-unusual. Remember, the market likes to fill them just like it did over here, and eventually it got that one there as well. So it can take a bit of time, but again, watch the FOMO, harness the feeling. That's really all we can do. Price action still remains up, 50% fib sitting at 42.30. Above that, we have the last gap, which is 42.76, and this big mega trend line towards the downside. Do remember, all markets cracked highs last time. Where are we right now? Cracking this high. We've discussed this concept. Anything in here, the risk reward for the long becomes not so good. But anything obviously down in these levels, it becomes much better. So this is not unexpected because the trend remains still bullish. If we go down to the 1 hour, we've discussed our defended areas quite a bit. I would have suspected that when that data came out, we might have actually come down, grabbed some liquidity, and then moved up initially. This happened. This entire move here happened in about, a minute. So the market was very quick to inject liquidity or eject a position there. There was really not many traders that got this zone unless they were already in. So again, the expectation of a pullback could certainly be there. These are the key zones that we need to be watching moving forward for the market to actually show a turn. It's still bullish. Higher peaks, higher troughs, higher peaks, higher troughs, higher peaks, higher troughs. And we always have repeated that. If you're bullish, there's no reason to still say that there's any bearish action just yet. We don't know that. We haven't seen anything happen. If we bust through these, then we expect pullbacks and of course shorts off those areas. At this stage, we don't have anything. So it's still bullish at this point, though it is slowing or dulling in terms of its move. Each move hasn't been that aggressive, and you can see any indicator you put on these charts are going to show negative divergence. That's what they're going to show across the board. Let's now have a look at the options. What's going on there? Well, max pain for this Friday, for the Friday session, we've got that sitting at 410. You notice here 40,000 to 42,500 SPY contracts. Basically, if the market was to achieve maximum pain, it would come down from its current level and go to 410. Now, we haven't seen that happening very often because usually the most important one with Max Pain, it's really all about the third week. Look at the options contracts now, 120,000. Then look at the maximum pain, 400 on the SPY. So this is kind of predicting that by the end of next week, the market should most likely be down rather than bullish if it's to achieve the maximum pain. At the moment, what it's doing is it's extracting bull calls. These are new calls. We haven't seen these ones opened like these levels for a little while. 420 now showing bullish action. We've also got 440, 446. People are starting to place bullish bets on the next week. It's what we want to see if you're feeling like the market's getting away from you. You want everybody to buy all these calls. More calls, the better, because what's going to happen is the market will manipulate. Remember, who sells the options to the retail traders? The market makers. That's why maximum pain is a concept. It cannot be relied on, but it certainly should be part of your analysis. Ethereum did bounce up pretty well. Crypto did all right. Ethereum just seems so much stronger than Bitcoin at the moment. If you're looking for the strongest of the coins, I feel like Ethereum is the big one. Look at Bitcoin here, just sluggish, terrible, frankly disappointing. It should already be at a new high from this point. So of course, will we get a 25k Bitcoin to maybe a 28,000 Bitcoin? It's possible. At this point though, it's still very nervous in terms of the volume and what's going on there. Not that impressed by this chart. And I think that Ethereum offers the better levels. Maybe a resistance around 2,000 here could be hit fairly soon. If you haven't already followed us over on Twitter, definitely do so. At FX Evolution is our handle. You can come into our Discord community as well. Over 10,000 of you guys sharing ideas daily, economic data, everything like that is in there. And we do have a private community as well, free 7-day trial in the description down below. The PPI number is next, 8:30 a.m. New York time. PPI number coming out. That should be an interesting one. And then we have prelim UOM consumer sentiment coming out on Friday, 10 a.m. New York time. A special thank you to, of course, Tiger Brokers, who sponsored today's video. And if you're interested in any of their special offers, links in the description down below. Thanks so much, guys. Subscribe if you enjoyed the video content. And of course, give it a thumbs up. Bye for now.